We've now started to see that come back. There is increasing expectation or pragmatism, let's say, that fossil fuels do have a role to play in the coming 10, 20 or 30 years, as much as we want to transition away.
We are here in Mannheim at the Fund Congress 2024. With me, Jonathan Waghorn from Guinness. Hello, welcome
Hello.
to Mannheim.
Thank you.
Jonathan, you're managing two energy funds at Guinness. How important is the traditional oil and gas companies for those energy funds?
Sure. So we run two energy funds, as you say. We have our Global Energy Fund, which invests purely in hydrocarbons. And then we have our Sustainable Energy Fund, which invests in companies involved in the energy transition and specifically excludes companies that extract hydrocarbons. We have companies in there that burn and combust hydrocarbons to generate power, but two very distinct universes. So the Global Energy Fund, it's all about hydrocarbons, but oil and gas, not really coal. And then sustainable is everything else.
In Germany, sustainable energy is a very important topic since the invasion of Russia and Ukraine. Are German investors maybe more skeptical now towards your strategy, or would you say they're even more open to get this exposure in their portfolios?
So we've seen a big swing in sentiment towards both strategies over the last 5 years. If we go back at the Global Energy Fund, exposure to hydrocarbons, yes, we've seen a very, very low level about 2 years ago. We've now started to see that come back. There is increasing expectation or pragmatism, let's say, that fossil fuels do have a role to play in the coming 10, 20 or 30 years. As much as we want to transition away, there is a need for them to keep the lights on. On the flip side then, with respect to sustainable energy and the whole theme of ESG and ESG premium, we saw that at a peak probably 2 or 3 years ago. That has most clearly come out of the system now, we would say. We actually look at our Sustainable Energy Fund, so that's all the companies not involved in hydrocarbons. So that's power production from a renewable form, it's electric vehicles and batteries. That portfolio, despite growing in the next 3 years on consensus numbers much faster than the market, is trading at a discount. So there, again, a massive swing around. In fact, now we'd say that the ESG has gone kind of violently the other way.
We've seen a conflict in the Middle East, of course. Is there any chance that it's getting more and more negative impact on the oil price, or what is your expectation there?
Yeah. We continue to see conflict and political pressure, geopolitical issues across the world of global energy. Typically speaking, they're reasonably short term. So things like the trade situation and the tankers moving through the Red Sea, we see somewhere sort of 8-9% of global oil traded through there, 8 or 9% of global liquefied natural gas as well. If it doesn't trade through there, it's got to go around the rest of Africa. That's extra time, that's extra cost. Ultimately, these things will work their way out of the system. We think about the broader kind of conflict in the Middle East. The big issue always around Iran is that we'd see the Straits of Hormuz being closed. That is 20 million barrels a day of crude oil going through there. Now that is quite significant. But ultimately, these things they play a reasonably short part and then disappear again. Ultimately, this all comes down to the cost of extraction. The price that Saudi is targeting, that's probably something like $80 a barrel. We'd see that as a long-term price.
And your biggest position in one of your funds is Shell. This year was like minus 6% performance. Why are you still positive on Shell? What makes it kind of your top position at the moment?
Sure. So the Guinness approach to running money is equally weighted concentration in our portfolio. So typically we think of most things being sort of 3 to 3.5% individual weighting, and we go through a rebalancing process. That's our philosophy. Our weighting to the super majors at the minute has drifted higher, and Shell is the largest of those positions. But we think of all of our positions really in a very equal manner. So Shell happens to be at the top. Yes, it's had a tougher time already this year, but I think global energy equities have as a whole. The position for Shell from here, by no means is it's a company that is disappearing. Okay, this is a company that is embracing the transition, but a sensible kind of pragmatic approach, sitting on a price earnings multiple that is around half of what we see for its US peers, so for Exxon and Chevron, offering a low teens free cash flow yield and an attractive growing dividend. Now, I would argue they are very interesting characteristics. It's a business that is being priced as if it won't exist in the future. And we would humbly disagree and say it is going to be around in 10, 20 and 30 years' time. So for us, no, we're still very happy with Shell.
So a positive outlook for energy and especially for sustainable energy has Jonathan Waghorn from Guinness. Thank you very much.
My pleasure. Thank you.